Well, hello, everyone. My name's Ed Stone. I am the long-term care specialist here at First American Insurance Underwriters. I want to thank you all for joining today on this exciting topic. It's one of my favorite things to talk about in the long-term care market. That's working in the executive carve-out world, working with business owners, talking about the need for what I like to call extended care planning as opposed to long-term care planning. So we're going to spend about 30 minutes going through the concepts, talking about the marketplace, where you should be looking for prospects, how to approach the prospects, and then the things that we can do here at First American to help you have a successful executive carve-out program going in your firm. First of all, a couple of things. Please, if you have some questions, go ahead and type them in the chat area. If we have time at the end, we will go through those. If you do want to take down my email, you see right there, estone@firstamericanfaiu.com. I will be happy to answer any questions that you might shoot to me via email as well. Second of all, everybody is on mute, and you don't need to have your cameras on. It's bad enough you got to see my face. So if you want to just turn your cameras off, and we'll be fine. So first thing we got to talk about, of course, is the fact that we're going to be giving tax and legal advice here today. We don't do that. We're not attorneys. We're not accountants. You should, of course, you and your clients should be talking to your own tax and legal counsel to verify everything that we're talking about here today. So this market is a little different than what I call the kitchen table marketplace. You don't want to approach this particular market the same way you would, a couple that maybe you're working with. Because business owners tend to be, and this is a broad generalization, business owners tend to be very dynamic, driven, self-reliant, invincible. I work 80 hours a week, been building this business, et cetera. I don't need to talk about nursing homes, et cetera, et cetera. So don't go into it with what I call emotional hand-to-hand combat, like you might do with talking to individual clients, if that's the way you do it. Because in this marketplace, you have to appeal to something that is more important to them. That's their business. So what we're going to talk about here is how they can help recruit, reward, and retain, the 3 R's: recruit, reward, and retain key people in their business. We're going to talk about how they can do it on a very selective basis. We're going to talk about the fact that with the different products that we use, we can design it in such a way that they don't waste the company's money if somebody that they purchase a policy for never uses it. And then, of course, we're going to talk about the fact that this is a tax favored type of situation. So if I was doing this in front of you, which I would do across the country for many years, I would ask you, which of these 4 things do you think a business owner would be most interested in? And most of the time, what I find advisors saying to me is, well, Ed, it's the potential to offer favorable tax benefits to the business, tax deductions. I'm here to tell you, in doing this since about 1996, that's important, being able to get something on a tax favored basis. But honestly, it's the second bullet point. The ability for once in their lifetime, their business planning lifetime, they can legally discriminate for whom they open their corporate checkbook. Every other benefit that you bring into a business, they get all excited about it. And then at the end of the conversation, say, oh, by the way, if you want to do something for you and your top people, because of this nasty thing called ERISA, you have to do it for everybody. And then you see the air go out of the balloon. I got to give my employees another thing just to get something for the people that are dedicated to my company and come in early, stay late, been with me since the garage, et cetera, et cetera. Yeah, unfortunately. Well, guess what? This particular benefit, corporately funded long-term care, can be done on a very discriminatory, selective basis. I'm going to talk about that a little bit more as we go through this. So if you were talking to someone, you would be able to say to them something along the elevator speech. As a business owner, and you may never hear me say this again, folks, as a business owner, the federal government is your best friend. And they kind of look at you like, what's wrong with this guy? Well, in this particular case, there's a benefit that the federal government is supporting that allows you to do something that's deductible, discriminatory, has an income tax-free benefit, even if you use corporate money. And if you never use it or your executive never uses it, the company's money won't be wasted. Would you have, a few minutes that we could have a conversation about this? That's really all there is to it. Now, you notice, what did I not say? I want to talk to you about long-term care insurance for you and some key executives in your company, because as soon as you use the words long-term care insurance, the blinders go up. So let's talk about, again, how they can recruit, reward, and retain top people, as well as taking care of themselves as the owners of the company. Okay, that's the whole premise around this. So that's a little different approach than talking about the fact that your family is going to need all this, et cetera, et cetera. Now, don't get me wrong. You are at some point going to have that same type of one-on-one conversation when you sit down and design a plan, because this is, a long-term care insurance policy. But the approach to this marketplace to get in there is going to be a little different. And before I finish, I'm also going to talk about how to partner with accounting firms to get into these types of situations, okay? So that's the game plan for today. Why can we do this? Because, as I said, believe it or not, back in 1996, in what I like to say, a fit of sobriety, the geniuses in Washington realized that there was this thing approaching our country called the silver tsunami, the age wave, the baby boomers, of which I'm smack dab in the middle of it. They knew that if they didn't do something to help incentivize people to take care of this extended life problem called long-term care, extended care, that it was going to bankrupt the system. Well, that was 1996. We're already seeing it happening now with the baby boomers like myself hitting Medicare, Medicaid, Social Security, et cetera. So they put into something called HIPAA, which we all know and love, right? We love the fact that we have to get all these things signed because of HIPAA. They put a whole section in there on long-term care. And basically what it said was, we want to improve the access to long-term care services and coverage. Now, when they did this back in 1996, they were really focusing, they thought, on individuals. The problem was that in order to take a deduction as an individual, and I'll talk about this more in a minute, you have to go through all kinds of steps. And since most people buying long-term care insurance back in 1996 were over 70, they were already on Medicare. But they put a whole section in there on businesses and how business owners could access purchasing long-term care insurance using corporate checkbooks. So that's what we're going to focus on here today. The first thing they did, may seem like a minor thing, the first thing they did is they qualified it as accident and health insurance. Tax qualified long-term care is generally treated as an accident health insurance policy. What's the big deal, Ed? The big deal is, until then, if I wrote a business check for my long-term care insurance, my accountant didn't know, how do I deduct this? Is it life insurance? Is it accident? Is it casualty insurance? What is it? Now we know that a tax qualified long-term care plan falls under the same rules as my group medical premiums that I'm paying for my group medical. So that was a pretty big deal, because now they have a reason to look at the tax deductibility. While the tax deductibility is, in my opinion, is not the driving issue here, let's get clear real simply how it is deducted. So when you start those conversations, again, with the disclaimer that unless you're an accountant, you're not giving tax and legal advice, but at least you're going to give some guidance for when you talk to their accountants, which I'll talk about again in a minute. So let's look at the way that these premiums are deducted. If it's a regular C corporation, 100% of the premium is a deductible premium. Now, if it's a traditional policy, it's 100%. If it's a linked benefit, I'm going to show you that not all of that premium would be deductible in a linked benefit plan. So, but for purposes of illustration here, regular C Corps, basically the premium is a deductible premium. It's also deductible for the spouse's insurance, because remember, this falls under accident and health insurance. Just like the employer gets to deduct the premium on a family plan that they're subsidizing, they get to deduct it for the spouse's policy as well. And in a regular C corporation, the premiums are not passed through as income to the owner of the company if they're buying it on himself or herself, or to the executives for whom they're purchasing a policy. So it becomes a very attractive situation if you have a regular C Corp. That's who I would look for first. Yes, they're not as prevalent as they used to be, but they're still out there. But since a lot of the companies are not regular C, how does the IRS look at partnerships, S Corps, and LLCs? Basically, what they say is this. You have to determine first, is the person for whom the company is paying the policy an owner or an employee? The test is, do they own more than 2% of the stock? If they own more than 2% of the stock, they are an owner. If they own less than 2%, they're an employee. So we got the Edstone Widget Company. I own 98% of the stocks of my S Corp. And in my magnanimous way, I'm letting all of you employees have the 2% to divvy up however you want to divvy it up. So clearly, anything I purchase for you is something I can deduct because you're my employee. But on myself or anybody else that owns more than 2%, I then have to treat it as a pass-through. So here's how it works. I take the premium for me, I pass it through, I pay the appropriate taxes on that as income. Now, what do I get to deduct? Here's what's interesting. I get to deduct based upon an age-weighted table. And here, by the way, is the 2022 premiums. And probably today or sometime this week, we should see the 2023 premiums. They usually announce them right around now. But I get to deduct, if I'm using my, my business check, I get to deduct this age-weighted amount. Big deal, Ed. What's the big deal? Here's the big deal. If I was writing a personal check, I would pass through the money. I could turn around and I could deduct that amount you just saw on the chart, as long as that amount plus all of my other unreimbursed medical expenses exceeded 10%, excuse me, 10% of 10%, I gotta change that slide, 10% of my adjusted gross income. That's if I use a personal check. But the IRS and Congress wants you to do this, Mr. and Miss Business Owner. So they said, pass it through, pay the taxes, you can deduct the age-weighted portion, irregardless of the 7.5 or now the 10% AGI test. They waive the test. So let's say that your business owner is 61 years old, or let's say 60 years old. So this year, they could deduct $1,630 each, spouse and owner and spouse. They could deduct $1,630 each of the premium. The balance would go to their Schedule A, and if they exceeded the 10% adjusted gross income, they could take the balance. It's not as good as 100% if they were a C Corp, right? But better than nothing. So in this case, what's interesting is, let's say next year when they're 61, look what happens to the deductible amount. Well, Ed, that's not very much in the younger ages. That's true. But it's the people in that 45 to 60-year-old marketplace. Those are the ones that are really in need of this type of a conversation. So the deduction does become pretty good as you get older. And again, it's for both people in the family. So first thing they did is they said, we're going to waive this 10% adjusted gross income test. The next thing they said was, it's in the code. Whenever I do these presentations, and I've done them in front of local and state accounting associations, and I go through that first part of the presentation to educate them, and they always say, well, this is good, Ed, but we're going to have to, look this thing up. We're going to have to figure out, how much is deductible, et cetera. I just give them the codes right here, which you will have available. Plus, we'll give you tax guides, from the carriers that have the carrier logo and stuff. So you can certainly share those with their advisors. But the first thing we say is, it is accident health insurance. It's right there in 7702B. So we know it's deductible in some way, shape, or form. Oh, by the way, I forgot one thing. What if your client's an LLC? How do you handle that? You ask the client this: how do you file your taxes? They'll probably say, I fill out the form, send it to my accountant, he filed. No. Do you file, when you set up an LLC, you set it up as either a personal corporation or a regular C corporation for tax filing purposes. If they happen to have set it up as a regular C corporation, then they get to follow the regular C Corp rules. If they didn't, they follow the LLC and the individually owned rules that we just went over. So don't overlook the fact if they're an LLC, they may have set it up that way. One example I see this a lot is car dealerships. They have a LLC that is really the money maker, but they have everything else in the C Corp, the building, the land, the inventory, all that stuff. And the regular C Corp pays money to the LLC for income purposes, but you have this C Corp sitting there that we could use as a 100% deductible entity, run the premiums through that particular part of the business. So again, these are the kind of tips that I want to help you with as you get these different prospects, get in front of these different prospects. So one of the things I also said was you can deduct give back the money if it's never used. Well, we do that through a number of ways. We do it through a return of premium, say on a traditional long-term care policy where they have a return of premium rider. We can do it with a life insurance-based contract where the death benefit passes through income tax-free. The reason we can do this is right here in the code, it says you can refund premiums upon the death of the insured as long as you don't exceed the aggregate premiums paid. Now, this was written for traditional long-term care, not for linked benefits, because we all know that a death benefit is always income tax-free, and usually you're leveraging a dollar to get more back in the death benefit. But as long as we're not giving back using a traditional policy more than we put in, it's fine. The question that I always get is, well, how would that money be treated under a true return of premium, not a life insurance death benefit? The answer is we don't know. We don't know if that's taxable or not taxable because it's a return of premium. There's been no private letter ruling or tax court case on it. So let's be conservative and just say, hey, let's say over the course of time, you paid 100 grand into this policy, you dropped dead. There was 100 grand from this traditional policy going back to your beneficiaries. So what if it's taxable? Who cares? That was money you were going to be sending to Washington anyway. So if they get 70% of it after taxes back, fine. It's better than not getting anything back. So the fact that we can do a return of premium on a traditional or a death benefit, which is always income tax free, on a linked benefit plan, hybrid plan, is very good. The other thing I talked about at the top end was tax-free benefits. This is markedly different than a disability income policy that I may purchase for you, my employees. If I buy you a DI policy and you go on claim, how's that money treated? It's taxable, right? If I buy you a long-term care policy and you go on claim, the IRS and Congress want you to be able to get more money. So they waive the taxable benefits up to, and this year it's $390 a day. Usually it's indexed. Last year it didn't get indexed, but usually it's indexed. So as long as my policy doesn't pay out more than $390 a day when I started the policy, an inflation rider is okay. But when I issue the policy, I shouldn't issue it for more than $390 a day, which is what, almost $14,000 or so per month. That's a pretty rich policy. The money's going to come to you, or if your spouse goes on claim, it's going to come to you income tax free. Deductible, return of premium, income tax free. What was that fourth thing we talked about that I think is the hot button? The fact that we can legally discriminate for whom we write the check, whose policy for whom we write the check. How can we do this? Because right in the tax code, section 105H, it says, as long as it is a fully insured plan. In other words, you're not self-insuring this with money under the mattress or under the desk in the office. As long as you're using an insurance policy, you don't have to follow traditional rules of ERISA. You can create an executive carve-out plan, and you can create that plan in a number of ways. You can carve up the census in an incredible number of ways. Law firms are a real good example. We've done cases where the equity partners get a really, really rich plan, 100% paid. The partners get this, the junior partners get this, the associates get this. You can cut and paste these censuses. The only thing I caution you against is building a class based on gender or age. Those are the two things that raise the eyebrows of attorneys looking for a big payday. So stick to ownership, tenure with the company, not occupation, but their title, what their job description is, VP, senior VP, directors. We can carve it up a lot of ways when you get the censuses to us. So we've got an opportunity here to talk about things that are deductible, discriminatory, income tax free. If you never use it, some money, either benefits come back, cash comes back, or death benefit comes back, depending upon which solution we use. Now, I did say that traditional policies are probably the easiest to work with because there's not a lot of moving parts. Unfortunately, we're down to about one carrier these days, not available in New York, unfortunately. We're down to basically one traditional carrier we have that we can do this with. And it still works, so it's not out of the question. But what we're doing a lot of these with is using linked benefit, hybrid, asset-based products, products that are based on a life insurance chassis. We can still do it. We just have to go through an extra step or two, because unless the linked benefit product breaks out the life insurance and the long-term care premium, if they break them out, we can use them. And we have 3 carriers that do that. So we can use a linked benefit plan. Basically, what we're doing is we're setting up an executive bonus 162. If you're familiar with that from the life insurance world, it works the same way in the linked benefit world. Basically, how it works is the life insurance portion is not deductible, but anything related to long-term care, the rider, extension of benefits, inflation, all that's considered a deductible part of the premium. If we want to get the life insurance portion deductible to the company, we do the executive bonus, which, as you know, is the employer pays the premium. Let's see this little chart right here. We go. The employer sets up a 162 bonus agreement with the executive. The employer bonuses out to the executive the amount of premium for the life insurance portion, because remember, the long-term care portion they get to deduct because it's health insurance. They bonus it to them. They don't actually give them the money. They don't send the money over to the executive. As we know, what the employer does is they send the premiums to the company. The policy is owned, though, by the employee, which, by the way, no matter what you're using, the employee owns the policy. It's theirs. They can leave, take it with them. We can set up what's called a restricted employee benefit agreement, which says if you leave anytime before 10 years or something like that, you can take it with you, but maybe we'll deduct from your severance pay a portion of the premium we paid. There's a number of ways we can do that to give a kind of a golden handcuffs. But in this case, the executive owns the policy. They get a bonus agreement plus money to pay the taxes. That's called a double or gross up bonus, so that they're not responsible for any money out of pocket. Now, they have to put that money in their pocket till April, the extra money that's going to be due on the taxes. But the employer sends the money to the insurance company. The employee can create, mention who the death benefit goes to. They do have access to the cash value. If for some strange reason they wanted to cash it out, they could. Not recommended, but they could. And of course, they can throw it into a trust or something like that if they wanted to, like an ILET. We've done that in the past. So while it's a little more complicated to use a hybrid plan, it does work. And the nice thing there is we can do 10 pays, we can do 5 pays, we can do 20 pays. With a traditional policy, we do have a carrier that still does 10 pays in most states, which is kind of like it used to be when we had 20 or so more carriers out there in the traditional space back in the day when I started doing this. So you've got a couple of ways to do this. So let me just get past this part of it here and talk about where you're going to find help. First place I'm going to suggest you go to is your own, obviously, book of business. This is where people know and love you. Well, they know you, let's put it that way, okay? Talk to those people. Please bring me into the conversation. Before you go talking to people, let's have a conversation, you and I can help you develop your pitch, so to speak. Feel free to include me in any conversation with your clients, but the best place to get leads on this are accounting firms. Now, historically, we know accounting firms aren't the biggest fan of insurance agents because all they think you want to do is get to their book of business, right? That's because how you've been approaching them is wrong. You need to start approaching accounting firms not by knocking on the front door and saying, I got the best thing for your clients. I want to help your clients. I want to do this for your clients. I'm the greatest thing since sliced bread, canned beer for your clients. No, talk about the side door, which is the one that they ask you to come in if you can help them with their practice. How would you help them? Because there's a whole bunch of accounting firms out there all doing the same thing. They're doing tax work, right? Some of them do other things, but to differentiate their practice, which, by the way, you should be doing for your practice, to differentiate your practice, you want to show them how learning this stuff can help them help their clients, who will then become their advocates, right? So it's going to go something like this. Mr. and Miss Accountant, I have something that you may not be aware of. It's called executive bonus when using corporate money for extended care, long-term care. If I could have 15, 20 minutes of your time, I'm going to bring in a consultant that we use, that's us, First American, on a quick webcast to show this concept to you. And what I think it will do is it will help you differentiate and expand your practice. How would that do that? Simply put, we come in, we educate the accountant. The accountant is waiting for that one question that they know you're going to ask, because all the other insurance agents ask the same thing. They're waiting for you to ask this question. And that is, at the end, I'm going to say to them, what do you think? Well, it sounds interesting. I'll look over the tax code, et cetera. This is the question they are waiting for. Do you have any of your clients in your book, Bob or Mary, that you think, fit the demographics, 45 to 65 years old, closely held business, been talking to you about this issue of extended care because they're dealing with their mother-in-law, and that sort of thing, mother-in-law. Yeah. Now they're waiting for the second question, which is what? Can I have their names? Can you call them for me? That's what they expect you to say. What you're going to say to them is, great. What I'd like you to do is I'd like you to call them up. I'd like you to go over the stuff we went over with them. And if you think there's an interest with them, then I'd like to bring you in, have you bring me in and have the conversation. Well, that's going to surprise them because they think that all you want to do is get to their clients. You want them to open the door, talk about the taxes, the stuff they're legally allowed to talk about, right? What they're going to do is they're going to get their clients in there. They're going to get their clients and they're going to talk about this. If they've got the right clients, the client's going to say, this is great. I've been thinking about this. You're telling me I can use corporate money. I can do it just for me and my top people. It's income tax free and we could set it up so that the money isn't wasted. I like that. Get that agent, in here. Let's have this conversation. So we come in, talk to them about that with you. We go in, help you write a few cases. You're pretty happy, right? You've made some nice commissions and more importantly, you've helped your clients. Is the accountant happy yet? Not really. They may bill their client for a little bit of time to explain this, but what's going to happen is this. That accountant's client is going to be out socializing with their fraternity or sorority, fraternity brother or sorority sister from college. They're the same age. They're talking about their families and they're moaning and groaning about taking care of their parents and their in-laws. And your client is going to say to that person who you don't know that owns a business, my accountant found a way for me to take care of this, lock up some key employees, deductible, discriminatory, blah, blah, blah. What do you think that friend of your client is going to say to your client? Who is your accountant? You're going to get referrals to your agency, to your accounting firm from your clients because you differentiated your accounting practice from the people next door who only sit there and do the taxes. That's how you network in this world, folks. It's not a simple overnight thing. Don't get me wrong. You're not going to call somebody up today and get an appointment tomorrow, but you're in the right season for it right now. The last 3 months of the year are great times to have these conversations because the business owners are meeting with their accountants and they're going over year-end planning. They're looking at planning for 2023. They're looking at ways, especially in this environment where there's a lot of rating going on of employees, with the low unemployment rates and losing somebody to somebody else. Your business owner clients are looking for something to recruit, reward, and retain their clients. Your accountants are looking for something to differentiate their practices to get new clients into their practice. And you, as an advisor who's doing this versus all the other people out there who aren't doing this, and believe me, there's not a lot of advisors out there that are looking at this market because you may not have known that all this stuff exists. So kind of in conclusion here, we're getting up on near the half hour that we promised. If you have some clients that are don't go after the IBMs of the world, the massive companies, because then you got to go to the board of directors, all that nonsense, and RFPs and everything. Find businesses where they've got a group of employees, in their 40s to their 50s. They've been around a while. They take care of their employees, but you've been able maybe to go in and do some split dollar stuff or some non-qualified deferred comp stuff. And they're looking for something that would really help their employees in the long run, stay with them. But don't forget the younger employees. Younger employees should be having this conversation because their parents may be 60, and in 15 years, when they got to start taking care of their parents, and they've risen in the company, and now they got to take time off to take care of their parents. Tell the employer, we want to help your younger employees grow with the company, not have to take time off if mom and dad are there, because these programs are available obviously to family members as well. So this can really branch out if you start to specialize in it. The premiums are good. You know, we do a lot of 10 pays because we're using corporate money. So let's just see by any chance if we have anything in the chat box. Nope. Okay, we don't. That's fine. At this point, what we can do for you is conference calls with you to train you up on this concept. We can be on calls with your clients. We can definitely be on calls with the accounting firms, because when you get through one of these with an executive, the first thing they're going to say is, well, let me run this by my accountant. Great. I'd love to have the conversation with your accountant. When could we get on the phone with him or her? This is a market that I think you'll find very, very helpful, because it's going to get you in the door where everybody has the same types of things. I do financial planning. I do insurance. I've got annuities. I do income protection. This is something that is different. It's something that your clients haven't seen. I can pretty much guarantee you that. It's something that your accounting firms that you like to partner with haven't seen. So let's make you an expert. Again, thank you very much. We will be sending out this PowerPoint to everyone that registered and attended here today. And I appreciate your time. One last bit, please stay tuned for Long-Term Care Awareness Month. Starts very soon. We will be having a series of 4 webcasts coming up, including some carrier underwriters, some carrier representatives, as well as some industry people in our 4 different things. So please, as you get the invitations from our marketing staff, please sign up for those. Even if you can't make all 4 of them, they'll all be warehoused, and you'll be able to get the videos of them all. Okay.